Welcome to the Thought Leadership Podcast, where we share insights on how you can become the go-to thought leader in your niche. I'm your host, Alejandro Sanoja, founder and personal branding consultant at Latin Empresarios, and today our guest is Jon De Los Reyes. Jon is a real estate investor and e-commerce entrepreneur based in Houston, Texas. He tried many different fields, from engineering to investment management. He wanted to find that ideal job and climb the corporate ladder. Unfortunately, he did not find one that aligned with his values. By sheer luck, he took an entrepreneurship class in his last semester in MBA school that made him realize his ideal career was something he needed to create. He built a 3-year plan that revolved around generating cash flow first from selling products online and then building wealth through real estate. He named his plan From Boxes to Buildings. Before his current endeavors, he worked for esteemed companies in the energy sector for 15 years. He established his foundation as an engineer and took on roles as an analyst, associate process engineer, project manager, and operations manager. He attained his MBA from the University of Houston in 2019. He also managed a student-run stock portfolio fund and held a fiduciary responsibility to its investors. Jon and his wife, Michelle, started a side hustle in 2020 by selling pet products online. It later evolved to Captype Pet Keepsakes, a company that designs, manufactures, and sells beautifully crafted dog and cat memorials on Amazon. Their products provide comfort in the toughest time as a pet owner. This is the boxes part of his plan. The building part happened in 2021 when they discovered the power of multifamily syndication. They went all in and have invested in over 1,000 apartment units in 6 months and want to share this opportunity with as many people as possible. They currently operate as co-sponsors on the DLRX Ventures. The company exists to positively impact business professionals to attain above average investment returns by investing in large apartment complexes so they can enjoy the things that they love with the people that they love. This content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. It's very important that you do your own analysis before making any investment decisions. Well, Jon, I'm so excited for this conversation. We were together in the Cougar Fund. I know you were doing the master's program to take your career to the next level. You had a full-time job at the time. And I know you recently decided to quit and dedicate yourself full-time to your venture. Can you tell me a little bit more about that, please?
Yeah, well, Alejandro, I'm really excited to be here and thanks for reaching out. I've been doing a lot of reflection in the past few days. So since COVID, we choose a theme for the year. So we have one word that will dictate the entire year. So for 2022, we chose the word transformation. And in order to transform, a person has to constantly go out of their comfort zone, right? One strategy that I implemented this year was the power of one more. And there's also a book about that by Ed Milet. Very powerful book. I suggest that y'all read it. And the easiest way to explain that is through working out. So I started focusing on transforming my health this year and joined CrossFit in May of this year. And, you know, the power of one more, like I think about it every time I go to the gym, like I'm so tired already, but I'm going to do one more rep. I'm going to do one more minute. I'm going to do one more step, right? So what happens is it breaks down your mental barriers and sets new one. Like your brain says, hey, you know what? I did this last time. I can do it again. Because our brain, our primitive brain was designed to protect us from pain, right? So it's fight or flight. So imagine doing the power of one more every day for 1 year. So I tested this one. So in October, a couple months ago, I entered my first CrossFit competition, right? And I was the oldest athlete at the in my bracket. So everyone was doing their sets already. I'm still like, stretching, warming up because it takes, I'm almost 40. Yeah, it takes longer to warm up now. There were 4 rounds. The first 2, and I promise there's a story behind this that relates to what I'm going to talk about. So there were 4 rounds. The first two, the judge announced that we were in the bottom. So I was like, oh man, so if we're gonna win this, we're gonna have a steep hill to climb. So round three came, which was the most difficult one. So we have a stationary bike. This was the workout, a stationary bike. And there's three of us. One will bike, and this is not a regular bike. This is called the assault bike. Like the name is like menacing already. So this is a bike that where you have like bars that you push like that as well. And we have to burn 200 calories in 11 minutes, which is a lot. And while that one person is on the bike, we had to hold a barbell, which is 385 pounds, while the other one's biking. So we were at pace, and then 10 minutes and 30. So we had 30 seconds left, and we still have 12 calories. And my teammate said, "Hey John, I can't do this anymore. Go." I was like, "Oh my gosh, I thought you were gonna finish it." So for 30 seconds, I just pushed, man. So I was like, one more pedal, one more push, one more pedal, one more push. And I even had my eyes closed. And then as soon as the time ran out, we hit 200 calories. And then I got off the bike. And I can't even say my legs were painful because I can't feel them anymore. So it was numb. I was there on the floor for a while. But anyway, so round four came. We did okay. We don't know where we were. And then the judge said at the end of round four, say, "Hey, John, you're tied with another team. You're going to go in a tiebreaker." And I asked her, like, for what place, third or fourth? And she said, "You're tied for first." So it's like, okay, let's do this. So we did this. And then at the end, we won second place, but it's okay because we lost to the head coach or the gym owner who designed the entire game. So that's okay. So I was pretty proud. But if I didn't have the mentality to push through that round three, we wouldn't have made it. And I think that's the same thing in life, right? So sometimes we've given so much, we don't think we have anything left. But if we do one more task, one more step, or one more day, you're going to push through. And I truly believe that. And that's what happened with my career. I changed careers 6 different times. And like, yeah, when we met, that was probably career number 4. So I never stopped looking for what I really wanted to do until I ended up with what I'm doing now. And I'm very passionate about what I'm doing now because we're in real estate investments. And I truly believe that financial independence can be attained much sooner than 65 years old. And I must play a part in that, in spreading that message. So there's a way that you can do that. In our space, we have teachers that retired early. We have physical therapists that retired early because they started investing in real estate. So it is possible for everyone.
Well, John, that is a fantastic story, and you've opened up a whole different avenue. I don't want to go there because this is not a podcast about CrossFit and working out. We're not experts on that. But in a past lifetime, just like you say you've had 6 career changes, I'm probably there as well. So in a past lifetime, I had almost all the CrossFit certifications, like the level 1, powerlifting, the powerlifting, the weightlifting. I did the Russian kettlebell certification. I was all into coaching and training. I did the Crush Games in Florida as well, and I know about the pain of our equalizers, the same as you, because there were a lot of strong people. Our story is not like, it doesn't have the arc as yours, but we were doing really bad, and the one that like positioned us a little bit better was the rowing machine, because I feel like there's a lot of those tests that with strength, if you're just stronger, there's nothing you can do. But the ones that are, I think those, it's kind of like more of a mental competition, the assault bike and the rower and running. Most of those, if you're like pretty similar, then the mind can make the difference. But maybe some of the time we'll talk more about that, because I wanna transition. I love that phrase that you don't have to wait till 65 until you retired, and it's, I didn't know this, but it's what we're transitioning to, because what we do is similar to that, in the sense that, hey, you can run your business and you don't need to be pushing all the time to
Correct.
make it happen, right? Like you don't have
Correct.
to wait until you're 65, like work, work,
Hmm.
work, 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 make money, and then at 65 enjoy it. You could do
Yeah.
it sooner if you do it the
Correct.
right way. So
Absolutely.
in your case, it's investing. You leverage investing to do it. We leverage building a personal brand so that
Correct.
you're able to do it. But I want to start. I want to
Yeah.
start with the negatives, right? We're gonna talk a lot about real estate investing today, but I want to start with the negatives, right?
Hmm.
What are some of the downsides that come with, because we know it with stocks, right? Like, hey, there's
Yeah.
some down markets. Maybe a company can go bankrupt
Yeah.
and lose all your money if you use too much leverage. You're buying options and whatnot. Um, so let's start with real estate. Nothing really comes to mind, right? Like there are not like there are crashes in the
Yeah.
market, but I'm sure there are other things that happen. So tell us a little bit about what are some of the downsides of residential real estate investing?
Yeah. So we are in the space of apartment investing. So we acquire large apartment complexes, and that's our investment portfolio. Now, let's differentiate, let's put a line between the stocks and apartments, which we focus on. So, stocks is really a global market, number one, in that, say, there is an outbreak in China or there's a rally in China about COVID, and it somewhat has an effect on the stock market. It also is a widespread, so like a national, so we have an international effect, there's also a national effect in that news across the US affect the stock market as well. In real estate is very localized submarket. Take Houston, for example. Say Houston is projected to have the number one population growth in the next 5 years. What that means is more traffic, more traffic and more population growth, and also job growth. Houston is number two in job growth, right? So those are the two economic drivers. So we have a local submarket for our apartments, and then stock is more national and more global. Now, we talked about negatives in real estate. So, like any investment, there are also negatives. So, one of the things that is not as favorable in apartments is, say, for example, you are going to be faced with natural calamities, right? So during Harvey, say, for example, so very important to look at if you're analyzing a property, is it in flood zone, right? Ask your managers, did the apartment flood during Harvey? So that's number one. Also, tenants, right? So there are um, the government helps tenants pay for their rent, right, through rental assistance programs, but there are also tenants who are not paying, right? Um, so you may have some tenants already in an apartment, they're not paying, therefore you're not generating income. So that's one of the main issues there. Now, both are preventable. Number one, definitely the first one, flood, you have to have flood insurance. And before you even invest in an asset, make sure it's not in a flood zone. And then second, with regards to the tenants, you have to hire an, a property manager that will properly screen the tenants before they even accept them to your property. You have to go through a proper screening process to make sure that these are actually paying tenants, because if these are not paying tenants, then we don't have any profit, and then we cannot return money to our investors. But yeah, those are the two ones that commonly come up. I mean, obviously there are some more, but like any investment, there's also risk in apartment buildings.
Yeah, that's a good point because since you're dealing with a lot more
Yeah,
people
yeah,
than if you're investing in a well, I
yeah,
guess you have that risk also with companies, right? Like if there's a
correct.
lawsuit because of something that an employee
Yeah,
does, you could
yeah.
have problems. Yeah, but that's
Oh,
that's a great point.
yeah. And also, I'm gonna add as well, expenses and inflation, right? Expenses right now, specifically insurance, is through the roof. Like the freeze that happened 2 years ago, right, in Texas, where we had freezing temperatures, we're starting to see that affect insurance rate, and it's driving insurance rates up. Also, cost of lumber, say we're going to renovate the property, we need lumber or metal. Inflation is affecting those prices as well. So what you're projecting 2 years ago when you bought the property may not be the same right now because things are expensive. So we're seeing those as well.
Yeah. Would you say that also another risk in terms of real estate investment, especially residential? In this is a question, I don't know if this is the case, but that you might be on the hook for more money than what you put in? Because I feel like in a stock, if you have like, I don't know, 10,000, half a million, a million, whatever amount, and you put it in stocks, you're on the hook for only that amount, and your risk is losing that money. I feel like, well, real estate, on the other hand, you could also be on the hook for something that you have no idea about, right? Like something happens in the property and you're sued, or something happens, right? Like you put a down payment, you're on the hook for a loan, and like a disaster happens. Yes, insurance is going to pay you, but it takes time, so you're on the hook for the monthly payments or something, right? So I feel like that could also be a risk.
Yes and no. In that, yes, it's not liquid anymore, in that you can't, like, if you want a renovation done to your house, you can't use that money that you invested in apartments and do that. But at the same time, real estate is a medium to long term game anyway. It's not going to turn out a profit in 6 months. So our investors come in with a mindset that this is going to be a 3 to 5 year period hold, that they're going to have to park their money for 3 to 5 years or until we sell the property, and then after that they can recoup it, and it's up to them what they want to do. So we always tell our investors this is a medium to long term game. If you need immediate cash, then it's not going to be liquid until we sell the property. To your point, also, it requires a larger investment amount, and that larger investment amount can come from different sources. So the common way is, typically people think, oh, I have to have this cash in the bank that it can wire with you, but there are actually other different ways to fund a property, like using your 401k. And this is something that I didn't even know that I could use to start investing. That's how we started. I used my old employer's 401k to invest in apartment buildings, cash that I didn't know that I could invest in alternative assets.
Oh, well, I do have questions about that, but before we go there, could you please help us define, because I know there are different types of real estate investing, right? Commercial, residential, and even in residential, because people like flipping houses might be one thing, right? Like buying and renting. I think nowadays even the Airbnb type thing that people are doing could be within those buckets. And then you have what you say you're doing, which is another bucket, which could be subdivided, right? Because you can invest in the way you're doing it yourself, and you buy your whole apartment, or you could invest with a group in different ways. So I don't know all the modes, but from your perspective, what are those different buckets of residential real estate investment?
Yeah, the two most common ones are single family home rentals, right? So, and that's what we were thinking before. So we were going to buy our neighbor's single family home, same exact floor plan. It was under market, and I can walk over there if there's an issue. Like I was, so that's single family home. The other one is multifamily. So those are the two main common ones. Multifamily apartments is anything. So when you say multifamily, it's anything 2 units and up, right? Where we play are apartment units that have 80 or more units, right? So we have large apartment complexes. And I love how you said it's flipping. So that's pretty much what we're doing. So we're flipping on a much larger scale. We acquire the property, and then after we acquire the property, we renovate the property, increase the value, and then sell it in 3 to 5 years. Right.
So you don't keep it as a portfolio forever, keeping the cash flow.
Correct.
You want to flip it and then do the cycle again with a similar property.
Correct. And the reason for that is, number one, investors want their money back. right? And then number two is the renovations that you did 5 years ago is going to be outdated in 5 years, right? So you're going to have to renovate it again. So it's better to sell it. And so let's put some numbers. So say, for example, just to clear the lines. So if we're buying a property, say worth $10 million, 60% of that, or 6 million, will be loaned. And then the 40% will be coming from the team that's managing it. So we're putting in money, and we're also raising capital from people who want to be in real estate, but they don't have the time, they don't have the experience, and they just want to invest passively. So these are passive investors, meaning, hey, I'm going to wire the money, please grow it. I just want my money back in 3 to 5 years. So those are passive investors. These are busy professionals who don't have the time, knowledge, or experience to do their own research. I was talking to a couple of friends of mine who own either own companies and told me, hey, I was going to buy this apartment unit, but I don't know what I'm looking at. I don't know these terms. So if you have a deal, I'm just going to invest with you. So those are the investors that, those are our passive investors. Yeah. And
So
then,
let's go
yeah.
ahead. Go ahead.
And one thing that you also mentioned is the team. We also work as a team. So in the team, you have people that will manage investor relations, talk to the brokers, people who have net worth, and people who are will manage the asset and execute the business plan. So we work as a team. I'm not working on my own. That will be very lonely. So I'd rather work with a team.
Okay. So that's good. So we can probably say that real estate investment, that's a huge thing, right? Because you could build office buildings, you could just buy an office and rent it. Then, so that's like commercial and residential. Then within residential, you can have like someone maybe renting some of the rooms, and that's kind of investing, right? Like, because you're getting some return. Then you could have people that maybe buy a home and they rent it, or buy a home and they flip it. And then kind of like the next level is 2 and up. It could be like apartment complexes that are small, or it could be those huge apartment complexes.
Huge ones, correct.
Okay,
and
so go ahead.
And our smallest one that we invested passively is 160 units, and the biggest one is 624 units. So it ranges, a pretty big range. It has a pretty big range.
And then I imagine that we could also go, there's kind of like up and down levels where you could invest to develop properties. Is that correct? Is that also something that you see happening, where there are groups that do what you do, but they go after maybe land and developing the apartments? Is that also a bucket?
Yeah, absolutely. Great question. And we can split that into three. So the first one is, like you said, they look for land and then they develop it from the ground up, right? So that property won't have a cash flow for the first maybe 1 or 2 years because you don't have tenants. So that's the first bucket. The second bucket is the Class A properties. So the Class A properties are these luxury properties with the most up-to-date amenities, new builds, like less than 10 years old. So these are the luxury properties, and you don't need to flip them because there's nothing to flip. It's just cash flowing, right? So that's your Class A. Where we are, which we like because we have the capacity to increase the property value by putting in improvements, which are the Class B, C, sometimes D, but we prefer the Class Bs and Cs. So what are these? So Class Bs are typically, if you look at the median income of the population around it, it's $50,000 or more. Class Cs are somewhere right below that. We like Class Bs and C properties, and these are like, early 90s, late 80s, early 80s properties, because these units are outdated. So we can improve the property, renovate the property, meaning if we renovate the property, we also improve the quality of living of the people that are living there. And then that increases the value, and then we sell it for a higher margin. That is called forced appreciation. So we're adding value to the property to increase to appreciate, to have the property value appreciate.
Yeah. And
And that's the Class B and C.
I would imagine that with A, there's no business model because whoever developed it, like it wouldn't make sense to sell it unless there's something like unless they're
Yeah,
going through financial troubles, right? And they
yeah.
really need to sell it for a reason because there wouldn't be a buying opportunity
Mm-hmm.
unless there's a drop in the value for something like that, right? Because like it wouldn't make
It's
sense if you just developed it to sell
the
it, and the price that you
yeah,
would be selling, it wouldn't make sense for the buyer because they're not going to make their
yeah.
money back.
The only reason why Class A would sell is, the team wants to cash out, or maybe they bought it 5 years ago. It's time to cash out. A Class A has different aspects in that, like from the very beginning, it's cash flowing right away, just typically. So the way we see it is Class A is like lower risk, maybe medium to high rewards, and Class B have the higher rewards, but also have the higher medium to high risk, right? I should say.
Right.
We have Class A's. We've invested in Class A in Memorial, and we chose that Class A in Memorial because there's a lot of businesses going around that, right? You want a Class A property in a Class A location. You don't want a Class A property in a Class B or C location because when recession hits, people are going to move out. Yes, because it's expensive for the area. You want to make sure it's a Class A in a Class A area. So,
That makes sense.
yeah.
Yeah. Now, so John, we've explored kind of like the gradient of real estate
Sure.
investing, then
Yeah.
the gradient of the residential component. Now,
Yeah.
could you walk me through the gradient of investing? Because right, because
Yeah.
you could do it like you said, hey, you're a high net worth individual, you have the money, you're gonna do it on
Yeah.
your own. I
Correct.
imagine that's one scenario. Then another one, you're gonna like try to set up a group together of people, maybe a
Mm-hmm.
couple of friends that are
Yeah.
there and they want to do it together. Then it's kind of like maybe you're gonna, instead of like doing it for your own, you're gonna start your own company like you're doing, and you're gonna,
Mm-hmm.
hey, I'm gonna get investors and I'm gonna be doing it. It's kind of like you are a real estate investor, but you're also a business, right? Because like
Correct.
I'm providing the service
Correct.
of this opportunity for other people. And then there's kind of like the, hey, I just have this money. Do I put it in stocks or do I put it in real estate
Yeah.
investing? So
Yeah.
could you walk us through
Yeah.
that line and also what you see as, I imagine if you do it on your own, of course there's going to be higher a reward because you get all the
Yeah.
benefits, but there's higher risk because you need to know the contracts, right? Like you don't
Correct.
have experience. There's a lot of
Mm-hmm.
risk here, a lot of reward. As you move in the middle, this probably makes more sense, right? Like doing it with other people or doing it like you're doing. And
Yeah.
then I imagine once you go into um, like your friends, the people that know you and investing with you probably have a better return than putting their money in just in stocks or in a fund, right? And then
Yeah.
there's kind of like the last tier, which is just like, hey, I'm just investing in a real estate fund to diversify my investments, but I'm really not getting such a big return.
Yeah.
So could you walk us through a little bit
Yeah.
that gradient and kind of like pros and cons in each of
Dude,
those
I
spots?
love how you describe it because that's how I would describe it too. So let's start with the end in mind. So for me and my wife, Michelle, we want to have, we want to own our own apartment building outright. That's maybe a 5 year, maybe a 10-year plan. And people who do that keep the apartment just for cash flow. They not no other people invest in it. It's just theirs for cash flow. So those are, like you said, you have to know the banks. You have to have your own property manager, or maybe you do it on your own. But you have to have a pretty good amount of capital to own an apartment building as well, outright. So that's kind of our end goal. So that's people who own apartments outright get it for the cash flow, right? And appreciation, of course, when they sell it. Now let's move into a group of investors now. And these group of investors, you can split it into two. This middle portion, this middle bucket is called the syndication, right? Syndication is what we're doing. We acquire a property, say 5 of us, five main or active investors, or we also call ourselves the general partners, or GP. So active investors, GP are all the same. So we're going to be the ones managing the asset. We find the asset, we underwrite it, we talk to the brokers, talk to the bank, find insurance, we do all that stuff, due diligence until we close the property. So that's the active team. Okay. Now, let's say there's 5 active members, and these active members need to raise capital of, say, right now it's about 40%. So other than their investment, they raise capital from passive investors. Now, who are these passive investors? Our passive investors are busy professionals, people who pay a lot in taxes, people who have cash but don't know what to do with it, and people who are, wanted to diversify out of the stock market, right? So we have passive investors here. They invest with us. We come up with a down payment, and then we acquire the property, and then we keep it for 3 to 5 years. Now, what is the benefit of being a passive investor? So there are 3 main ones. So as a passive investor, they get dividends or distributions every 3 months. So you have that dividend every 3 months. It's about 45% now. It was much higher before the interest rate hike, but they get quarterly distributions. When the market conditions are great, then yeah, they get distributions. But if expenses go up, like right now, it's better if the active members just keep cash right now, just in case things get worse. Okay, 3 months, and then at the end, when the property appreciates in value, the active team sells it, and then they get a big chunk of return, right? The last one is tax incentive, and this is how, when you see people not paying taxes through real estate, this is, I can't say it's a loophole, but it's actually a tax incentive. Why? The government gives you a tax incentive if you provide 2 things as a company: provide jobs, provide housing. And we're here, we provide housing. There's a portion in the tax code called bonus depreciation. And I'm gonna try to explain this the simplest way possible. So bonus depreciation allows you to deduct a large percentage of your investment and take it as a loss all in year 1. So you have a huge, massive loss in year 1. And 2022 is the last year where you can have 100% of loss in year 1. So, okay, so you have this loss year 1 in your tax document, and say you have other passive investments that you have to pay capital gains on. What you can do is, instead of paying taxes, you can offset this loss to eliminate those taxes that you're paying. Essentially, you're not paying taxes on your passive income. So that's, a lot of our investors are doing that just because of the tax incentive. So yeah, so just in summary, as a passive investor, you get dividend distribution, depending on the market condition, obviously. You have capital gains when you sell the property, and you can have tax incentive to reduce a big portion of your cash, right? So that's the syndication business, right? And then the last portion is an investor that wants to diversify through real estate, but they invest in like a CrowdStreet or Fundrise kind of deal, right? Smaller investments, small returns. Now, let's talk about returns as well. In a syndication business versus a stock market, I actually looked at the graphs. So, and you may know this as well. Since the S&P 500, since its inception, it has returned 11.8%, like since historical numbers. In the past 20 years, it dropped down to 9.8%. That's without inflation, right? In apartments, we typically see anywhere within the 15 to 18%, maybe even 20% for some really good deals per year. So you get a 20% return per year on your invested capital. So those are the 2 comparisons that we.
Is that a combination of the cash flow plus
Yes.
at the end? Okay.
Correct. Yeah,
okay.
And that's average annualized, right? Because the dividends that you get every quarter is, like I said, 4 to 5%. But the big chunk is when you sell the property,
Okay.
right? If you annualize that, then that's where you get your 13 to 18%.
So I guess then the downside for someone, like, of course, if you're an active manager, there's a lot of, like, if you're an active manager, you're not investing, you're running a business, right?
Both. Yeah. You're investing as
I
well
mean,
and you're running a business.
yeah,
Correct.
yeah, you're investing like any business
Correct.
owner, but
Yeah.
like it should be described as you're an entrepreneur, right? Like you have to deal with hiring people, like,
Yeah.
and there's a ton of risks.
Oh,
And then if you're on the investor side,
yeah.
the risk, which I would think, because like, and I have a question about that, but okay, if you're
Yeah.
gonna make 20% versus 11, 10, or
Yeah.
9,
Yeah.
it's a no-brainer. But what I'm thinking is like the risk from a limited partner would be either you have to trust and know the person, the
Oh,
active
yeah.
managers, of course,
Yeah.
right? Like,
Yeah.
and more
Yeah.
than like more than like it requires a deeper level of due diligence and research than just putting your money on Facebook,
Yeah.
right? Like
Yeah.
you
Yeah.
really need to know this person.
Man.
You have to do the research, and then the other downside would also be like stocks that you don't, and you're a limited partner, you don't have a say on that much.
Yeah.
But the other risk would be selling at a bad price because you didn't manage your cash flow, or something unexpected happened, which could happen in the, like, people lose money in the stock market, not because of the stock market, but they make bad decisions, right? Because
Correct.
if you diversify properly and you buy low and sell high, and you don't let your emotions kick in, you should make that average, right? Like, I'm not going to say you're going to be rich, but you should make the average.
Yeah.
You're going to be below average if you make bad decisions. I'm thinking in real estate, you're going to be below average if you invest with a bad manager that, like, I don't know, embezzles money or whatever, or they didn't do a good job with their managing, and you have to go out at a time where it doesn't make sense, right?
Yeah. Yeah. And I love how you describe it. You're right. You're investing in a business because you have to run this property. And when you invest, you're actually buying a stock of the company that owns the property, right? So you're an investor. As an investor, you're actually investing in a business to grow this property, because you have, project managers to execute the business plan. You have property managers. You have tenants that pay rent. So you're investing in the business as well. When you invest, and this is how we're doing it, you first vet the team. That is the first thing that you got to look. After you vet the team, you're going to look at the market. And then that's the only time you look at the property. That's how we do it. If you don't mind, if your listeners are interested, I created a checklist that saved us from losing money on a deal. And this checklist is pretty extensive. Say, because this property didn't check off these items, we're not going to invest. So I can share that with your listeners as well. But this saved us a lot of money. Now, how do you know? So it's know, like, and trust, right? So you got to know, like, and trust the active managers. These active managers need to have a good track record, meaning they've bought and sold properties. They have a good track record, and you want a active manager that is transparent and communicative, right? I was talking to a friend of mine, and he said that I invested in a property in Oklahoma. They held it for 5 years. I only made 13% return, which is very low, instead of 80%, 80%. But he said, you know what? I'm going to invest with that manager again, because we had so many unexpected things happen. We have natural calamities, we have rising costs. And he said he communicated every step of the way. He was very honest. We have problems. This is what we're doing. And because of that, I'm going to invest again with him. And that's how we, when people talk about this, that's the one word that we want them to think: transparency. We're transparent, because transparency builds trust, right? And if you have trust for a longer period of time, then you build long-term relationships. And the number one currency of relationships is time, right? So if we
Mhm.
have that, we build strong relationships. What we want is to have a core group of investors that will invest on every deal with us moving forward. So we think long term. It's not a one and done deal for us. But yeah, you're right. So you have to vet the team that manages the property, then the market, and then the property.
Yeah, yeah, and we'll link to the checklist that you mentioned.
Yeah,
Now, John, if anyone's listening,
yeah.
you're thinking, okay, stocks versus real estate investing.
Mm-hmm.
So far, real estate investing sounds great, right?
Yeah,
Like you have better returns, you
yeah,
have cash flow. Why is it that most people are not doing it yet? Because you, for example, I know there's different levels to this and
yeah,
the sophistication of the investor, but you hear a lot of people talk about stocks, and we joke
yeah,
about this all the time because of the Cougar Fund. Um, People think that just because they can buy a stock, they can compete. And
yeah,
the example I always give is it's like jumping in the ring with a boxer or going one-on-one against LeBron
uh-huh.
James. You don't
Yeah,
see it, but on the other side of that trade that you are doing, there's like
uh-huh.
professionals doing it. You're gonna
Yeah,
you're gonna get punched in the mouth if you don't know what you're doing. But still, you listen to a lot of people like, I bought this, I bought that. It's kind of like a
yeah,
general thing to invest in stocks, and people
yeah.
do it. Why
Correct.
is it that if real estate is such a great deal, why don't we hear more people talking about real estate deals and investing like stocks?
Okay. Um, there's common misconception about real estate, which I'm going to get into. I want to talk more about stocks first because you and I both traded stocks for other people, and that was quite the experience. One of the best experience I've had. Uh, just full disclosure, we still own stocks. We have a diversified portfolio of real estate and stocks. Now, stocks is the most common investment asset class, and 40% of Americans own stocks. Um, it's easy. And you can invest a small amount. Now, I'm gonna share my experience why I didn't think I could invest in real estate, especially in apartments. When so I walk my dog every day past an apartment, and a couple of years ago I said this would be really cool to be part investor in apartments, and then I found out about the power of apartment syndication. And I was talking to a family friend who serendipitously we met in Mount Zion in one of our trips. And we started talking about it. And I asked them, so are you saying, after they explained the concept, are you saying that I don't need $500,000 or $1 million to invest in to be a part owner of an apartment? I said, yes. Okay. And are you also saying I can use my 401k to invest in alternative assets? I said, yes. And my last question was, are you also saying that I can stay in one of the apartment units for free? It's like, no, that's not part of the deal. You cannot do that. But yeah, so people think that the barrier for entry is too high, like unachievable. It is higher, but it's not unachievable at all. So, and that's the mental barrier that that prevented us back then from investing in real estate. We think it was hard, we think it was expensive, and we thought it was high risk, honestly. But yeah, and that's one of the few reasons why people don't invest in real estate. And the last piece is they just don't know that they can.
Mhm.
It's breaking that mental barrier of, hey, you can actually do this. You can be part of a 100+ unit or 600+ unit apartment, and you can be proud and show this to your kids or your parents and drive them by there. Hey, I'm a part owner of this apartment. But you can't stay in it. But I'm a part owner. So, yeah,
Yeah.
I think there's a big mental barrier and lack of awareness of alternative assets in the market, and that's why not a lot of people are investing. So,
No, that's a good point. Now, do you know the numbers? Because you mentioned
yeah.
40% of American own stocks. Do you know what that
Mm.
number is for real estate investing?
No, I wish I did. That's actually a good
Okay.
question because there's a
Yeah.
lot of there's commercial and yeah.
Because I think you would know there how big the opportunity, because if that number is like 5%, it's like, oh my God, how much opportunity, right? For people to actually learn about this.
Yeah.
But if it's like 35, it's like, oh, we're close to
Correct.
getting there.
I do have a graph that I will share with you. I just can't remember, but yeah, I
Okay.
saved it. So
Now let's say we're going through this conversation and I'm thinking, let's use me as an example. I'm like, this
yeah,
makes so much sense, right?
yeah,
You're talking about the diminishing your tax liability
yeah,
with what you talked about. Then also I know you can diminish it by, if you sell it, you just buy a bigger property,
yeah,
and then you keep deferring tax.
yeah,
So in my head, I'm like, this all sounds great. So if I ask you, hey John, how much money do I need to get started, what would you
yeah,
tell me? I want to
yeah,
invest. How much money do I
yeah.
need? What do I need? what would
It's
you
not
what
half
would
a
you tell
million
me?
dollars.
Okay.
The minimum is typically $50,000. $50,000, and like I said, people either wire it or use their 401k to invest in alternative assets. It has to be an old employer's 401k.
Is it
Yeah, so
50K because uh someone like you who's managing, you don't want like people just 1,000 because it would be just troublesome
yeah, man.
managing a bunch of people? Or is it 50K because of some SEC rules that you have to have a certain level of income to be able to invest in it?
It's a matter of the complication of having more investors. And we have to talk about the type of investors as well. There, we only accept two types: accredited or sophisticated, right? So accredited investors have a net worth of, say, over $1 million, or make an income of 200 to 300K, right? The other one are sophisticated investors, and this is the you have to know the merits and risks of the investment. So it's not like we can accept any investment from anyone. They have to be a sophisticated investor. They understand the concept, and they've invested in other asset vehicles as well. So stocks, and maybe they have some real estate, but they understand the risk and rewards. And the threshold is like this, just to filter out, as a natural filter for
Yeah.
people who don't know what they're getting into.
So legally, how does it work? I know like we're not lawyers, so
Yeah,
this is not valid, but
yeah,
to the general public. But I know, for example, like, okay, to be an accredited investor,
yeah,
we know for the Cougar Fund, it's like 200K plus
yeah.
or 1 million in assets. That's kind of like
Mm-hmm.
clear defined.
Correct.
How do you like? Is that something that the SEC has some way of like? How do you determine who is a
Yeah,
sophisticated investor?
yeah.
What are the parameters? Because
In
like, for example,
a
I let's say
Yeah,
I want to invest with you. I don't qualify yet for
sure.
the accredited
Accredited.
investor,
Yeah,
but I'm like, hey, I want to invest. Like, how would
yeah.
I know if I qualify for the sophisticated one so that I'm able to invest?
Yeah, the there are deals that are purely accepting accredited investors. There are deals, this is typically where we play, um, that accept sophisticated investors and accredited investors. So in one deal, the one where we typically play in is called 506B, as in beta, 506B. We can accept up to 35 sophisticated investors. And if you're
Oh,
an
okay.
accredited investor, we can have an unlimited amount. For the other type, which is 506C, which only accepts accredited investor, you have to submit the certification that you are an accredited investor,
Oh, okay.
right? But we typically do the 506B just so we can include sophisticated investor. And honestly, that's how we started. We were a sophisticated investor when we started.
So that is on your side, I guess, the legalities and everything.
Correct.
It's on, like, I would just, like, if I tell you, hey John, I'm not an accredited, but I want to invest with you,
Yeah.
here's 50K, I would just give you the money. I'm sure just like we have to sign a contract or something,
Sure.
but
Absolutely.
the legalities of showing that I'm sophisticated, like, it's up on you and the way you structure
Yeah.
the deal, not necessarily on me as an investor. Is that correct?
Correct. There are two buckets. One is you can do sophisticated and accredited, and one is just purely accredited.
Okay.
But yeah,
Okay.
and that's how you structure the deal. It's in the legal contract. this is this type of deal, and then the other one is just accredited investors. Yeah.
Okay, because
And
I was
then
wondering because I've seen a lot of people like Grant Cardone and other people offer
yeah,
deals to not
yeah,
accredited, and I'm thinking because
yeah,
I know of course because the Cougar Fund we know a little bit,
yeah,
so I'm like, how are they accepting less like this amounts of money
yeah,
and
yeah.
they're not checking if
Oh,
people are so that makes sense what you said that it's like because there's a vehicle where you can get it and it's
yeah,
up to you to because I guess in your case it's like hey I'm not a big company I don't want to be dealing with
yeah,
calls with people who just gave me like $1,000 or 5,000. I want to make sure that it's like
yeah.
people who are just going to give you the money and let me do what
Correct.
I know how to do. But you were
Yeah.
going to say something.
And
Go ahead.
the other kicker there too is for the sophisticated plus accredited type of deal, you cannot advertise that. You cannot put it
Mm,
on Facebook. And the people that can invest in your deal are the people that you know already. They're SEC guidelines that you know already before you have a deal. It's
the
not like,
deal.
hey, I
Oh,
met you at
okay.
the network. We have a deal. Here's the deal. Can you invest? No, it's not like that. You have to have pre-existing relationships with these sophisticated and accredited investors. The
Okay.
other type of deal, the purely accredited, you can blast that on LinkedIn, on Facebook, on Instagram, and that's what Grant Cardone is doing. I think that's what he's doing
Yeah.
for some of the deal,
Yeah.
mainly accredited investors. Yeah,
Oh, and that makes so much sense because then you're
yeah,
protecting the investor by
yeah, for
because with
sure.
a pre-existing relationship, you
Hmm.
should know a little bit more about the person to
Absolutely.
versus like if someone is great at marketing and sales and
Yeah.
they just like get your money into
Yes.
something that you don't really understand if your money's going to be
Yeah.
stuck there for years, that
Correct.
makes a lot of
And
sense. Now I
there's a
understand.
big alignment in this. Again, this pool of five sophisticated and accredited investor. There should be an alignment in goals. Like we say, hey, you know what? This is the dividend that you're gonna get. This is the cash flow. You're not gonna get it until later on. Are you okay with this or not? We're buying this property. If this is aligned with what you want, then great. But if not, if this is and this is what I tell my friends as well. If this deal is gonna put a dent in our friendship, if this turns out bad, then this is probably not the right deal for us. Right? I'm honest like that. Like I said, I'm transparent. I mean, it's uncommon, but it happens still. You know?
Hmm.
Yeah.
So again, everything I'm seeing and learning about real estate is that it's a great opportunity.
Yeah.
Now, what would you say it's the learning curve? Let's say instead of me asking you, hey, John, I want to invest with you, I ask
Yeah.
you, hey, John, I want to do what you're doing. Could you mentor me through starting my
Yeah.
own real estate investment company? What would
Correct.
if you were building, just like you have that checklist, that it's
Mm-hmm.
great to um, have like screen properties,
Mm-hmm.
what would your checklist or your plan, your mentoring plan would be if I asked you that question? Okay, first, I don't know, you need to use this checklist and learn how to screen properties. Then you
Mm-hmm.
need like a great property manager, or these are the skills you're going to need. Like,
Yeah.
what would that plan look like if I asked you that question and you were going to mentor me as
Yeah.
another real
Yeah.
estate investor?
So are you talking about passive or active?
Active. Let's say like, hey,
Active.
I want to
Okay.
do exactly what you're doing. I want to start my own fund syndication.
Yeah.
I'm excited. That's exactly what I want to do. I know we would be kind of like, let's say we would be competitors, but let's say
Yeah.
you're like, yeah, I'm in because I believe in abundance. I believe in what you're doing. I actually want to help you
Yeah.
do the same thing. What would
Yeah.
that development like? What would you recommend me? I know this is a huge question, but
Yeah.
let's say you're gonna give me a plan of like, hey, read these books, do this, and know, and these are the skills that you're gonna need because you're gonna face these challenges. Like what?
Okay. The best accelerator of education that I found is getting a coach. So that is the first step. And that's what we did. We got a coach. We joined, so we got a coach and we joined a community, right? So we joined a coaching program in Dallas, and we were surrounded by people that have been doing this, are successful, and are generous in sharing their time and knowledge. And why do I say start with this step? This because a lot of it is gonna come from your mind. It's all a mental thing because you're like what happened with us this year. We transformed from one to another with the help of a community, with the help of your coach, the guidance of your coach. You can create a completely different mindset and go after this goal. So that is your base foundation, right? The second is take courses after you get your coaching, do the modules, and actually invest in some passive deals. And that is one of the best ways to learn the hands-on experience of the asset. Because after you invest passively, you get monthly newsletters and say, hey, you know what? This is our financials. You see what's going on in the property,
Many
and you
tenants,
can
yeah.
tell a lot. Yeah, yeah. And so, and that's one of the best ways to do it. So you
Yeah,
got
it
a
would be
coach.
kind of like shadowing, right? Because you're seeing everything
Yes.
that's going on, but you
Yeah,
don't necessarily making the decisions.
absolutely. So invest in a few of those. Invest in multiple in different markets. Honestly, we're all in Houston because Houston is a great market for population growth, job growth, and we have the Houston Astros. How can you not invest in Houston, right?
Yeah.
So yeah, we have 5 properties in Houston, but yeah, try with different markets, submarkets. So try to invest in different states, different submarkets, and then attend a lot of networking events to get your name out there, right? So that's number 4. In every event that, or any networking event that you can, show up. I don't know if you know this, but I am internally, I'm a huge introvert. I'm a huge introvert, and now I'm here in the multifamily syndication. So believe it or not, we took a test of with 50 people, my entire team of introvert extrovert, and I was on the very leftmost part of the introvert scale. I was that number one person, the most introvert out of the 50, and now I'm doing this. But at a certain point, I had to break out of my own shell, and sometimes I dread going to networking events, but I pull myself out there, and when I'm there, I was like, oh my gosh, I'm so glad I went because I met this person. Right. So get
Yeah.
coaching, community, modules, networking. And the last thing is start building those relationships because you're going to start capital raising if this is what you really want to do. You're going to start raising capital from people. And it's better to be prepared and not have the opportunity than have the
Hmm.
opportunity and not be prepared. So
Yeah.
start you're telling your friends and families, hey, I'm in this business, so on and so forth. I don't have a deal now, but when the time comes, I'd like to talk to you more about it. So yeah, but everything starts with the mind, and everything starts with the coaching and the community. So
Yeah, no, those are great points. Now,
yeah,
so it seems that basically there's kind of like different uh I think ors is the word that sometimes I
yeah,
forget
yeah, yeah,
English and Spanish, right? Like you need to be kind of like you need to be really good at what you're doing,
yeah,
but because of the limitations of because I feel like there's a big opportunity in the sophistication. Like there's probably a lot of people competing for the accredited investors, and it's
mm-hmm.
so difficult to compete there, right? Like the budgets for that is
Yeah,
just like are just
yeah,
immense. So it seems to me that the opportunity with the in the sophisticated investor space. And
mm-hmm.
because of those limitations, you also have to do a really good job of expand your network so that you
Mm-hmm.
have proof that you knew them before. So is it something like, can you, if someone subscribed to your email list, can you market to them because they know you because they gave you their email? Is it like, what are the lines in
Yeah.
that knowing them before the deal and knowing them before or after?
We're a little bit unusual in our approach in that we don't really send newsletters. We don't, send a lot of marketing. We don't really send marketing materials because the best way, going back to knowing, liking, and trusting, is face-to-face interaction. We meet with investors over coffee, over lunch, over dinner, um, and then we just build relationship through that. And then we text them during the holidays. That's the best way to build the long-term relationship that you want. Now, um, Sure, you can send them emails, you can send them marketing materials, but I think that's still the best way that we found is to build a face-to-face connection with people. Yeah.
So let's talk about that networking and those
Yeah.
connections.
Yeah.
How do you then, let's say you're at an event and someone asks
Yeah.
you, hey, John, what do you do? What is your typical answer? Because we've been talking, like, now I'm understanding way more about what you do, because I saw your other podcast, I saw your
Yeah.
LinkedIn post, and it's like, oh, it's cool that John is doing this. I want to learn about that. Let's have a
Yeah.
conversation. But in now I'm understanding more and more. We've been talking for an hour. Sometimes you don't
Yeah.
have an hour to communicate that message. So
Yeah.
when someone asks you, what do you do? What is your typical answer nowadays?
I say that we help busy professionals get above average returns by investing in apartment buildings so they can do the things that they love with the people that they love. It's as
That's
simple as that.
Yeah, that's a great line. And then do you have, I know from your website that you talk about oil and gas professionals and
Yeah.
medical professionals.
Mm-hmm.
Are there in your experience so far, are there any people who are a best fit to work with you and to invest with you?
Yeah. There are multiple avenues, and of course I've obviously we want to niche down. So my wife is in the healthcare industry and I was an oil and gas professional. Um, our niche is people who are, as I alluded before, busy professionals who don't have the time, the experience, the knowledge to invest in real estate, people who have cash, people who are paying too much in taxes, and people who want to diversify outside the stock market. So those are the four things that our typical investor profile fall within those four buckets. And I wanted to mention also as well is like talking about the know, liking, and trust piece is how do we connect with people? And the way we do that is it's 3 steps. So number one is we show that we're ordinary, and I'm going to explain why. Second step is show that we are extraordinary. And the third is to explain our why, right? Ordinary means, since we're talking about target niche, ordinary means, hey, I work an hourly wage. I was on the shop floor as well. I had a corporate job. I worked 12 hours. I was burnt out. I was broke. I was depressed. So depending on who I talk to, say, I feel your pain. I know what you're going through because I went through that as well. So that's the ordinary part. The extraordinary part is say, hey, you know what? The pain was so much that I had to take massive action. And this is what I did. I read books, I set up this business, and then I set up this business, I invested in real estate. And then the third one is to share your why. Why are you doing this? And as I mentioned earlier, I truly believe that people can achieve financial independence way before 65 years old. That's number one. And the second reason is we want to, on the personal side, we want to make sure that our parents are covered when they get old and they don't have to worry about medical bills. So that's really a big driving force for us. So we ordinary, extraordinary, and state your why. So you start with the other person's language, and then you end with your language. So, and that's how, we build relationships.
Yeah, no, that makes a lot of sense, John.
Yeah.
This has been a marvelous conversation. I have so many more questions about real estate and investing, but I want to be mindful of your time. Is there anything else you'd like to share? We'll link to your website, we'll link to the checklist you mentioned. Is there anything else you'd like to share with the audience?
Yeah, if I may share as well, a lot of when I was starting, I was surrounded by, I was lucky enough to be surrounded by community that helped me and taught me how to do things. But one other thing that I did was I read books. And one of the books that I read is called Passive Investing in Commercial Real Estate. It's $20 on Amazon, but I have a link. This is not my link. I'm just sharing it, where you can just pay for shipping for $5 and then you get the book. So I'd like to share that with your viewers as well because it eliminates all the jargons and it's very easy to read. It's a very thin book. But yeah, I'd love to share that with your listeners.
Yeah, absolutely. Well, we'll link to that in the
Yeah.
checklist. Jon, thank you very much for being on the podcast.
Yeah.
What an insightful conversation.
Yeah.
And to everybody out there watching or listening, thank you for being with us, and we'll see you in the next episode.